Property Show 2021 by MediaCorp and our partners 99 Group and top real estate agencies Propnex, ERA, Huttons, Orange Tea, and SRI. I should say Orange Tea and Thai, right? Yes. I am Vanessa Lopez, your host for this morning. Our second session this morning, I'm joined by two speakers, Harvey Chia, Head Investment Advisory and Strategist of SRI, and Ramesh Pillai, Assistant Director of Orange Tea and Thai. We will be talking about how to leverage property as a viable asset class. Now, any wise investor knows to diversify their portfolio to manage risk. But how can property be added into the mix? How much of your portfolio should property take up? Well, we're going to find out right now. So we'd like to welcome Ramesh and Harvey. Hi, guys. Good morning.
Hi, good morning, Vanessa. Good morning, everybody.
Good morning.
So you guys staying safe, broadcasting from home?
Of course.
Studios that are private and away from people.
Of course.
Okay, great. Let's dive right in. For our audience who isn't familiar with the different asset classes, can you give us, all of us, a general overview of what these different asset classes are and how much property as an asset class should factor into an ideal portfolio? Harvey, you want to start?
Okay, sure. I guess for asset classes, there could be quite a lot, like stocks. I think a lot of people are familiar with bonds. A lot of people are also familiar with real estate, commodities like gold, silver, and stuff like that. And of course, other derivatives in the market. So every different asset class plays a different role in your portfolio based on the risk profiling, based on duration that you hold it. And in Singapore, I guess property as an asset class, as part of the portfolio is very natural, right? Because we look towards home ownership. So a lot of people from young, they buy a property. So real estate is already very much part of the asset class. And as we grow older, we aspire to own more. So real estate will always be part of the portfolio in every single Singaporean's portfolio. I would say so. Yeah.
Okay. When I ask how much should factor into ideal portfolio, should you say, like, is there a percentage that we can apply to that?
I mean, there's no magic number, but I guess property in Singapore is not as cheap, I would say, as overseas.
Not as accessible, for
correct.
Yes. Okay.
So
okay.
I would think that as you grow older, the portion of real estate in your portfolio would continue to reduce because you maybe sell off and recycle that capital into other asset classes as you grow older, maybe for retirement. So when you're younger, it's more, maybe 60%, 70%. As you grow older, that number should reduce. Yeah.
Okay, we'll be getting to that question later on.
Yeah.
Ramesh, at any point you want to jump in there, please feel free. Yeah.
Yes. It's what I had to say was the four asset classes. Historically four asset classes, and I think Harvey mentioned a few. It's fixed income, bonds, stocks, cash equivalent, and of course we have real estate. But I think over time there's other financial derivatives. Even cryptocurrency is considered asset class now.
Dogecoin.
But I like to look at how Robert Kiyosaki categorizes the asset classes. He because when you talk about stocks, bonds, and other derivatives, it's mainly paper class assets. But Robert Kiyosaki he finds this, although it's diversification in its own right, it's the four categories that he recommends is business, commodities, paper assets, and real estate. So looking at these four different classes, I think when it comes to asset allocation, it's very important for all investors to know how to allocate their portfolio to different classes so as to diversify risk. But I think it's a bit arbitrary in a way that there's no optimal formula, especially when you're looking at property. Property is a very unique class asset where different people view it differently. Some people just want to use it as purely as a roof over their head. Some people look at purely for investment, but more often there's a blurred line in between. So in terms of allocation, for me, I think you have to look at three factors. Mainly it's time horizon, your personal goals, and risk tolerance. So that's how I would approach the whole asset allocation.
As you would with any investment, what is your risk level type, especially with like stocks and shares and all that. You need to see what your risk is like and see what your different situation is. Like for me, we bought a house, even though it's 99, because we're not going to have children. So they, probably die in it and live in it and die in it. We're not going to leave it to anybody or whatever, so there's no value. But why is it critical for an individual to have a diversified portfolio in different asset classes? Ramesh?
Well, I have quite an interesting perspective. I mean, the traditional thought again is, don't put all your eggs in a different basket. But there are other people like even Warren Buffett or Mark Cuban who's come out and said that, diversification is protection against ignorance, and you can diversify enough. You cannot diversify enough to know what you're actually doing. So there are arguments against diversification, but I mentioned earlier the different. It's always good to look at the different asset classes and not purely diversify within an asset class. It's between different categories of asset class and diversification within each category itself. So I think some people get caught up. They think they buy different asset classes within the stock, so they feel very diversified, but it's not so simple. So I think it's important.
So don't just buy one condo and one EC and one HDB. You should also diversify your money elsewhere.
And I think when you talk about diversification, what comes to my mind is also the correlation. So the correlation between the different asset classes, how they will perform in terms of in times of a recession or a crisis. Not all different classes of assets react the same way. So that's one of the reasons. And when it comes to property, it's traditionally been a very good asset class. It's inflation. It's a hedge against inflation. And it has a relatively low correlation to other asset classes. So that's why I think traditionally property is viewed as a attractive asset to invest in.
As a viable investment, I mean, there are many property types. You got public housing, you've got private condos, landed commercial REITs, and so on. What are some of the general starting points if an investor wants to leverage property as a viable asset class? Harvey?
Well, maybe I would like to categorize it a bit differently. I think amongst the things that we have mentioned, maybe public housing, like, property is kind of like a want and a need. As what Ramesh mentioned, some people would take property as like a roof over their head. So for like public housing, it's more of like, a place to stay, for example. And if today we're talking about investment, real estate as an investment, I think public housing in Singapore is not likely to be kind of like an investment, right? It's more like a roof over your head. We don't expect to see like 10x.
I don't know, man. Have you seen some of the Bishan and Queenstown properties?
I think from the policy perspective, I think public housing should continue to remain affordable to everybody, and you should see it more like a home.
Yeah.
But in terms of investment-wise, I think private condos, landed, these are still like residential properties that people aspirationally would like to upgrade to and own it. Now, but there are many other things that you could buy into, like commercial. But on the backdrop of COVID, perhaps the perspective towards such properties may change. When COVID kicked in, sometimes landlord may have to give rebates to tenants when they're not doing so well, because the perspective to watch their cash flow stability will be very different. Whereas for residential, I think that it's still more resilient in times where, like COVID. So to dovetail what Ramesh had mentioned earlier, I think that, even different asset classes in real estate, different segments provide a very different perspective. Residential is more resilient. Commercial probably would be more affected during such situation, including even those individual strata retail units. REITs, from another perspective, would be access as a starting point, perhaps, to certain people who would like an entry point to asset classes that they can't buy on their own. For example, if you can't buy a hotel on your own, right? It's unlikely. I mean, it's very unlikely you'll buy a shopping mall on your own. So you're basically buying pieces of what you could, like a share in REITs, on the public listed market, whereby you could then buy little pieces and get distributable income. REITs have a rule where the 90% of the income is being distributed, whereby you can then pass that responsibility of managing the asset to somebody that is professional. They will manage the asset for you and then distribute the income to you. So I guess if you are somebody that would like a bit more hands-off approach, probably you can go buy a bit of REITs into asset classes that you can't access on your own. But for residential, you can be a bit more hands-on. There's more aspirational aspect to it. And there's also pride of ownership, you know, a nice address. If you own an asset in that place, you enjoy it, you like all the amenities and stuff. I think that still plays a part towards even as a starting point as an investor, you could also look into that as well.
Ramesh, any thoughts on that?
Yeah, so you mentioned a few categories. So I feel that because each category has its own set of eligibility criteria, restrictions. If you're looking at HDB, there's things like, you know, your income eligibility, if you can even buy to start begin with, the MOP period, the 5 years, then there's MSR, ADSD, the amount of down payment for private properties. Everything differs. Every category has a different set of requirements or eligibility criteria. So as a starting point, if you were looking at all these different categories and you're confused where to start, I would say starting point, do your homework, really, and also assess your own financial situation. Truth be
Or speak to
told,
someone like you guys.
yes, of course. So as Harvey mentioned,
absolutely.
if you're purely looking at brick and mortar investments in Singapore, you do need a substantial amount of savings. So it's not really something you can just decide to do tomorrow. You need to plan a lot. You need to plan your time frame. But as Harvey mentioned, REITs is an interesting alternative where you can go in with at a very much lower entry point, and you can still own a piece of real estate.
Just for those who are not familiar with the REITs, can you explain it to us? Like me.
REIT stands for Real Estate Investment Trust. So basically, you are buying into a piece of a diversified portfolio, which includes many different properties. It could be a retail REIT, there are office REITs.
So it's almost like a unit trust of property.
That's correct. Yes.
Okay. Okay. If someone comes to you and says he or she wants to start investing in property, can you give us some general do's and don'ts that you would advise them on? Harvey.
Well, if someone wanted to come and invest, wanted to start their journey in investing in property, typically what I advise my clients, which I typically look at the whole portfolio, or in fact, like now more of like second generation, some of my clients, their kids getting involved, buying a property, very aspirational. I would basically tell them like what to do is, do your sums, right? Like first thing, property, it's not something that you can buy today and decide to dispose of tomorrow. There's a lot more commitment to it. And, in Singapore, if you buy a property, there's a holding period. If you were to change your mind within 3 years, there will be seller stamp duties that are payable if you were to buy and then you decide to sell it within 3 years. So I guess there's a minimum duration that most people logically would hold it, which is in the market right now around 3 years. So I'll ask them to do their sums properly. That's one. I'll ask them to, probably come out with what is their, likely investment goal. About how long will they hold it? Maybe what kind of returns are they looking at? And are they comfortable to be in this position if, let's say, they're holding it between 3 to 5 years? And I will tell them my biggest advice to a don't is don't FOMO, right? Don't just buy because of fear of missing out. Other people are buying something, you rush in and you want to know what the action is. And without even doing enough homework, you just buy because your friend bought one. I think that it's we've been lucky. I think a lot of our property in Singapore, especially the projects, are well built, and aspirationally, a lot of Singaporeans like to buy. Foreigners like to buy in Singapore as well. but it could be your everything, you know. So there's one position that you take. I think it's important to do your due diligence as well.
Yeah, I think it's also good to have a good outlook of your life plan in the next 3 to 5 years. Because let's say I'm going to start a family, what kind of house would I want to have? I need more room, so I would need to get a slightly bigger room, maybe.
Yeah, yeah,
And then there's also the parents to think about as well.
or if you need to broadcast from home, right?
I need that's right. I need an extra room for that.
Yeah.
Okay, well, that's great. Any do's and don'ts from your side, Ramesh? Because you mentioned just now, do your homework. Anything you want to add to this? Some do's and don'ts.
It's not too different from what Harvey said. I mean, for me, it's about having a clear goal, know what you want, research the market thoroughly, and another thing that I think a lot of investors we talk to don't seem to have a good grasp of is their credit history, how much loan eligibility. I think this is a starting point for me. So the first step you need to do is really talk to some banker and see how much leverage you can get. I mean, that's the topic for today, right? So I think that's one of the very first steps I always advise my friends and clients whom I speak to. I think that's a good point to actually start planning, what kind of properties you can even start looking at. For the don'ts, I would say, try not to be too emotional. It's hard, but more often than not, people tend to be too emotional in their purchase. It's definitely going to be some emotion involved, especially if you're looking for own stay. But I strongly advocate to also use logic and research to back up your purchase, so that you don't only buy a property because of a location. It cannot be just one singular factor that is influencing your decision. Because it's a good location, everyone's it's a hot location to be in. It has to be a few other factors like future growth plans in that area. What is the exact unit that you're buying? Is it a small or a big one? What is going to be the rental potential? So many factors. I don't want to go into too much detail, but I think
I think this is based on experience. So people have come to you after they bought a place, and then they come back and go, "Oh wait, I made a mistake. What can I do now?" Have you encountered that?
Thankfully, no, not really.
Good. So that's good. I mean, I think the good thing is when you speak to an agency, I think they would help you get through all the pitfalls and say, okay, what is your risk factor? So that's definitely a very good step. In terms of strategies, should investors focus on their property investments for their regular monthly rental income, or plan ahead for capital growth? What about using them as a hedge against inflation? Harvey, any thoughts?
Okay, I have some thoughts on it. I think in Singapore, it's kind of like a two-pronged thing, right? Recently, you see data has been showing strong sales in resale. Data has been showing strong sales in new launch. And I think that when you buy a resale unit, which is already built, then obviously I want a cake and I want to eat it, right? I want a good rental yield. I want rental income. And as I manage that along the way, and then I pick and choose, like how I advise my clients that if they were to buy a resale with the income, and then it should be able to cover their mortgage, right?
Yeah.
So someone else is paying the leverage for you, your loan, they're paying that for you, the interest portion as well. And then we pick and choose a time whereby we see the numbers. And if the numbers are starting to plateau for a particular project or particular unit that they hold, then we will recycle that capital. And that will be a strategy, right? And we'll use the same money and then profit, and then we'll move into another position. Now, another way in Singapore where people actually typically choose as a route one for property investment is typically to buy a unit from a new launch, which is what you say, you see a show flat and then you walk in and you look at everything and then you buy the property off plan, which in Singapore, it's a wonderful landscape whereby developers continue to deliver projects, almost on time. Of course, now with COVID, there's a bit of delay, but, we've hardly seen a case whereby developers don't produce the goods that they promise. So in that case, that would be a different kind of investment whereby during the period where you bought that unit, there will be no rental income. But progressively, as you take the loan, they will draw down on that loan based on certain milestones. Now, this property that you buy, you will deliver it about 3 years later. Earlier, I had mentioned about seller stamp duty. So typically there's a 3-year holding period. Now there is a first point of exit whereby if you get your unit, you may so feel that, okay, say for example, you had bought this unit, say 3 years ago, and then the situation of COVID didn't really ring on your mind. And now you feel that maybe this unit's a bit too small, or maybe you need a bit more room, and you say, you know what, Harvey, let's move on, right? Let's change our position. Now, for a new launch, upon TOP, when we collect the key, we can then choose to sell the unit. And there you will probably realize some capital growth. So in that regard, that profit from that unit may not be from a rental income, it could be from capital growth. So naturally in Singapore, we have seen real estate have a steady climb. Of course, there were bounces through the years. I know we saw the Asian financial crisis, we saw SARS, we saw the Lehman crisis, and things like that, which we cannot predict. But it has served its position from a real estate to hedge against inflation because the resources have remained expensive, right? Land prices are continuing to escalate. Construction costs as well has continued to escalate. So I do feel that getting into position, even if it was for a home, could eventually also turn out as a home investment because things do get pricier. And I'm sure, Vanetta, if you've bought your place, you do feel that, hey, you know, I would better off have bought that property like 5 years back or something like that.
Oh,
true?
it's always in hindsight, always, right?
Yeah.
Ramesh, any thoughts on that?
Well, I feel that the investors that we speak to, some of them have different needs. When we look at capital growth, it's for a number of reasons, from funding retirement, supporting children, hedging pure returns on savings. Typically, these investors will look out for properties in nicer, perhaps more central locations, and buy homes that they can imagine living in as well. And it's a more long-term strategy. Whereas there are others who, the mindset of rental yield property strategies is more immediate income. It's perfect for those who just want an additional stream of income every month. So it really depends what is the immediate goal. Of course, it's, as Harvey mentioned, it's good to have both. But I do agree with Harvey because I do new launches as well that are bought off plan and where you can't actually see the actual product. But this is in a way some sort of interesting hybrid where yes, you don't get the rental income immediately, but you can actually just hold on to the property until you get the keys. And once you get the keys, you have the option of just selling it off for at the market value, which usually has appreciated over the 3-year period, or you can rent it out as well.
So sometimes the development just takes that long that you actually got past the 3 or 5 year stamp duty, additional seller's duty. Okay.
Maybe I just hop in. I think in a typical timeline, it would probably have been 3. I think now there would be, a bit of a delay, and then it could be slightly longer than 3.
Fair enough. Yes.
Yeah.
Do properties normally do well against inflation? Does it rise together with the market value?
I would say, yeah. I would say absolutely. I would say,
absolutely, right.
yeah. I would say so. Yeah.
Well, in terms of it's two-pronged, right? So there's rental income, and then there's price appreciation as well. So when you look at these two factors, it usually does help with inflation because once price go up, you will also increase your rent. Then at the same time, the value of the property is also going up. So that's why it's one of the best asset classes to fight against inflation.
Unlike cars. Moving on. in terms of asset allocation, okay, how much, I did kind of touch on this earlier on, how much in percentage terms should investors dedicate property investing to? Okay, so similar to like our obsession with food, the saying is we shouldn't overindulge and yet not miss out entirely. What's a good figure? I think we've sort of touched this. Like you don't have a percentage to put on this, do you guys? If I force you.
Well, Ramesh, any thoughts?
Well, I would approach it as from different personas. So who are we looking at? Is it a fresh grad who's just starting off at the job? So his allocation of course the capital entry level, it's too intensive for him, so he won't be able to allocate assets. So maybe from a starting point, he should be looking at more stocks and equities and bonds, and then eventually use that as a means to enter the property market. For a typical ordinary income Singaporean who is very apathetic to all these different financial investments too complicated. Typically, I think it entails about 90%. That's what I feel. I think there's a lot of that. I mean, I talk to different people. Some are really, really passionate about investing and growing their portfolios. Some people just don't really care.
Right.
So,
I mean, I feel that as a young person, last time lah, obviously, I actually wish that I had gone a bit further to borrow actually against my parents, but I didn't have enough to borrow from a bank, or just find the funds, because there were lots of new properties. And as a young person, like I think I was 21 or 22, I wanted to buy something, but I just couldn't. What would you say to someone in that age, in this early age right now, in this climate, the year 2021, as an early 20-year-old, and I just don't have enough of that cash to put down? What advice would you give to them?
Well, if I may just make a point, I think that we do see a changing of guard in the property market right now. As you can see, we have all segments of the. I mean, maybe I'll just focus more on residential. There's a lot of things going on, right? HDB has seen over 2,000 unit sales in the last, I would say, 9-10 months, which is absolutely awesome. Prices are going up, and this group of people are now in the market, looking to upgrade in the condo market. And the previous investors that were holding the investment units, they sell them and then they move on and then they go buy a landed. And you look at our pioneer generation, whereby, they feel that, maybe landed, it's not so good for them. They'll climb up
I
the
want a
stairs,
smaller
right?
place. Yeah.
Correct. And then they will downsize, right? So we see a changing of guard in the market right now. And quite a number of my clients who I know since my my consultancy days or my banking days, they are exiting those positions, whereby some of that funds would go towards helping their kids make that first step in a property journey, which I have also been pretty supportive of, because the truth is that's what it is, right? Because the whole property journey goes by life stages, right? As you grow into your 30s, 40s, you can borrow more, but property market has gone up. As you go older, you have gone the full circle and capital values have grown. So I think it's also a very smart strategy to recycle that capital towards helping your kids to just make that first step, not to buy the whole property, but just get them in, and you could draw down a personal agreement with them or whatever, just to get them in. But a property journey can start anytime, but not everybody may have that access to parental money to help them get into the market. But I guess if you could, it's something that you can perceive, because one thing good about real estate is it is a sort of a discipline. When you buy real estate, you may be able to afford the first down payment, but to pay your mortgage every month, it's a way of financial discipline, which I had advised some of my clients for their kids as well, whereby they are responsible towards their money and then paying down for that property through time. It's also a very good
It's almost like a forced
way.
savings plan, really, if anything.
Kind of, yes.
And
Correct.
Ramesh, what about you? I mean, is the allocation change over the investor's lifespan from young to older?
Yeah, definitely. So the personas I was talking about, the last group of people I had is the retirees who they're well heeled, they have a property that's well paid for. Now their considerations are more legacy planning, retirement. So I think they would their priorities are to be less risk takers and to really grow that nest. So are they going to expand their property portfolio by taking some equity from the property that they already own? That's a consideration for this group of people who want to expand their portfolio but still be very safe,
right,
and not take risks. Yeah.
I mean, look at today's volatile market, though. Does that mean that the short, medium, and long-term investments, they have to change their view quite drastically, or does it not change? Judging by how the Singapore Property Show, even the last time we did a show, the market hasn't really changed. If anything, it's been strong. So, but are they changing in terms of their short, medium, and long-term view of their property assets? Ramesh.
I feel that what the pandemic has inevitably done is, in times of a volatile market like this, the property market is always it's considered a safe haven. People run back to. I think that's what has sort of happened over the past 2 years, where despite, it's almost like a paradox. At one point you see market going a bit crazy, and then people are just rushing to show flats buying property. So it's hard to understand this, but if you look at it closer, the reason is brick and mortar investments over liquid paper assets are always deemed a safe haven. And I think that's the reason during a time like this, people always come back to property. And that's why I think be it medium or long term or even short term, property has always been one of the choice assets.
Harvey, any notes on that?
Well, I take another
Umbridge?
perspective. I take another perspective on this. Actually, I do believe that in Singapore, especially, actually real estate is not that illiquid as an asset. We are a rather transparent market, and we do see, even in the current situation, right, of COVID, that the market is pretty liquid. There are a lot of transactions being done. I think the developers are actually still selling well. I think the individual investors who hold resale units are actually still selling well. So I do see Singapore real estate market as being pretty liquid versus, for example, in Southeast Asia, the prices could be cheaper. It could also be a capital city, but selling it is not going to be as easy. However, I do still think that everybody should still have a time duration in their mind. What is considered short, medium, or long term? Because according to my clients, some of them, the short term could be 5 years. Some of them say, hey, you know what, I want to get out in 3. Some, for them, long term it's 15. Some say 7 years is long term for me. So I think individual client portfolio, when I advise them, I would typically check with them what is their perspective of this. But I do believe that in Singapore, if you buy a decent asset at a decent price, if you hold it for a minimum duration, I would say about 5 years, I would still feel that it's pretty liquid. In fact, most of my clients have been able to exit their positions and invest and recycle their capital multiple times through their portfolio readjustment and reallocation through time. Yeah.
Okay, because my next question was, is that the general advice to pay off the property as soon as possible as well? And in one case, is if you're very liquid, fine, you can just pay off the cash and whatever. But if it's not, then should the advice be okay, pay it off as soon as possible or sell it as soon as possible? What's the general thought there? Harvey? Oh, sorry, Ramesh.
Okay, yeah.
I guess looking at the current interest rates, I mean, the cost of funds are really, really low. It's like a historical low now. So typically, I think this is a good time. You really have to decide given the current circumstances. And I feel that, given the situation now, it's good to actually leverage more and enjoy the lower cost of funds, which can maximize leverage and retain more cash for other investment opportunities, like it could be REITs or stocks or whatever. But you should take advantage of the situation now where interest rates are really like a historical low.
Wow. Okay. Harvey, any thoughts on that?
Okay. Every year I would have this practice, right? I would look at this report from MAS. It says a financial sustainability review, right? So in December, there was a report for 2020. And since 2017 till now, the household housing loan to value ratio, the debt has dropped from 53.5% to around like 48%. And I think that's the reason for that. I think more people, as through time, as property market, they have made some money off the property market, have chosen to be a bit more prudent in terms of paying down their property. Now, but on the same heel or breath as what Ramesh is saying, I do feel that the interest rates right now for the market still remain very attractive. And the power of buying real estate is through leveraging. Of course, your returns will be higher if you borrow at a cost that is lower than what you're getting in terms of yield. But that being said, once again, if we go back from a portfolio perspective, now if somebody say for example, is not as is more risk adverse and doesn't want to take on more risk, and if they leave cash sitting around not doing anything, they should probably look towards, interest savings in itself is also a smart strategy. By paying down part of their loan and, save on the interest is probably the only thing that they'll ever do with the cash that's sitting around. Then perhaps I would advise them that, yeah, maybe that would be a great way to go about, paying off your loan. However, if my client's profile is somebody that's willing to take on a bit more risk, then perhaps the money that you use to pay down your property could be redeployed from a portfolio strategy into other asset classes that could generate a better yield for you. Because let's not forget, buying property, the leverage, your cost of funds is maybe 1%. But if you go and leverage in equities, if you go and do like bond financing, that interest cost is not going to be so low. So there needs to be a balance between risk taking as well as interest savings. So it really depends on the individual. So I have to look at the portfolio of the client, then I can advise better. Yeah.
Okay. In some countries, having a mortgage usually contributes, excuse me, to tax credits. Does that apply here?
I think Harvey is a better position to.
Over to you, Harvey.
I guess in I would say maybe certain countries there are some tax credits that you can save if you were to offset the interest on your mortgage, offset the rental as part of taxable income. But I think in Singapore we don't see that direction. And that's it.
I think that's Australia you're referring to, right? I think they
and other markets as well. Yeah.
Okay, so in you've got a lot of years of experience in this industry. So in your years of interacting and communicating with clients and investors, what are some real world examples of individuals you've met and how they are leveraging property as part of their portfolio of investments? Ramesh?
So I know this particular client. It's a couple. They started off in a HDB. I think within a span of 10 years, they were able to sell, buy. I think they sold 2 private properties after the HDB and eventually moved to a landed property. So that's the period they took. Of course, economic situation, their income growth also helped them to achieve their goal. But it was quite I would say, interesting and very exciting to see how they managed to, really just stay focused on their strategy. Not big risk takers, but just very prudent choice of the next upgrade, which eventually led them to their final goal, which was the landed property. So
how many years did they take?
Approximately about 10 years.
10 years. Wow, that's not bad. That's interesting that be able to do that within.
And most of the money was made from buying and selling.
So they had the 3-year or 5-year stamp duty, the second housing.
Of course, 10 years ago, we didn't have that.
Okay.
So the initial.
Was it only 10 years? I thought it was more than that. Okay.
Yeah.
Missed. How about you, Harvey? What are your some?
Don't worry,
of your...
Vanetta, you'll have your opportunities. You got Ramesh and me, so no worries.
Nice.
Right. Okay, I do have 2 examples to share. In terms of leveraging real estate as a portfolio of their investments, in my experience in my work, I have done 2 things for, I would say, particularly 2 types of customers. One type of customer would be the kind that, the well-heeled, like what Ramesh has mentioned, and they already have their positions in real estate. So what I would also suggest to them could be to speak to their bankers to do an equity term loan kind of leveraging, whereby if your property is fully paid up, you got equity inside, right? It belongs to you. It's just that it's sitting in brick and mortar. It's not so-called liquid, right? So you go speak to your banker, and if your conditions and your profile suits that, you can draw out a loan from your fully paid up property, which they can then use it to purchase another property instead of having to sell out of their position. So that's.
But that means also buying the additional buyer's stamp duty and all that.
They could be buying it in trust with their kids. That means they don't pay. They set up a trust because this property is meant for their kids anyway.
I knew I should have had kids. Yeah.
I don't worry. So I'm losing out the same as you. But that doesn't stop us to from exploring that for our clients. So that's one. 2 is, of course, there are people who have done their the ABC. as what Ramesh has mentioned, like this couple where they did, the ABC, right, from public housing to condo to landed. And I think this is the journey that, even personally, I have gone through. And I believe that it will continue to be the Singapore dream, right, where everybody would, be able to get into a position, sell, and then make good profits and move on. It doesn't even have to be an investment as a separate unit. It could be a home investment where the home that you stay in will end up being your investment, where you make money and then you can continue on your journey to upgrade. And at least that is what I look at. There is no, that we don't leave anyone behind, right? There will always be opportunities for everybody. But once again, if I look at your portfolio, if I look at you as an individual, it really depends on your profile and what what your goals are. Yeah, correct.
Ramesh, did you wanted to add something?
Yeah.
No, not really.
Oh, okay. So I thought you would put your hand up or something. Okay. So let's get to our let's get into our questions from our viewers. Maggie Sasanto says is asking, with the ABSD when buying second properties and additional effort to manage the rental as passive income, meaning renovation costs, facing bad tenants risk, relatively low yield of income or rental income, is it recommended to invest in REITs rather than investing in physical property? I'm talking about a second property here. Harvey or Ramesh, either one of you can get into this one.
Okay, maybe I'll just take this. Maggie, the question was from Maggie, right?
Maggie, yes.
Yeah, hi Maggie. Good question. I think perhaps maybe Ramesh and I both hear this kind of questions all the time. I think there's a fundamental difference between buying a physical property and managing it and buying REITs. As I mentioned earlier, I think buying REITs, right, it's still like a share class. It's like stocks. Although you do get more hands-off kind of approach where it's being managed by professionals, you have a portfolio of properties, you have like distributable income and dividends, right? However, you have no control over the asset, and you still will continue to see flux in the stock market as well. Whereas as a physical real estate in Singapore, you pick and choose. You cherry pick whichever property that you want to buy, and you dictate as and when you acquire and as and when you sell the property. There's a lot more control. So therefore, if even with ABSD, I think it is all part of the conversation in everybody's property journey today to take ABSD as a consideration. I personally feel that if you had to pay ABSD, then it really depends on your duration, like how long you want to hold that property. I'm not saying that you shouldn't pay ABSD. I think that if you have a specific reason to pay ABSD, then it's good to speak to your trusted advisor to have that conversation and then plan around it. REITs is not it's not a yes you should buy physical, no to buying REITs or buying a physical property. I think both have their merits, and it really depends on your timeline. It really depends on your individual, and if there's any way for you to mitigate that situation. Yeah.
So maybe I'll add on to that with maybe more like personal experiences. I've invested in REITs as well, and when the market crashed during the lockdown, the pandemic recession, the REITs crashed as well. So that is always that risk factor you have to consider. I agree with Harvey. When it comes to real estate, the control you have over it, it's always a bit more comforting. You can decide what you want to do. You can renovate the house, engage the best salesperson. Hint.
But it wouldn't the same mindset of hold my position, I'll just hold on to it. Same for brick and mortar, but same for REITs as well. It's something that can just hold on to and wait for the market to build back up again, if I can afford to, of course. That should also apply, shouldn't it?
Well, at the end of the day, there's still a lot of other parties involved in REITs. There's many other factors. It's still more volatile as compared to property, which I still do feel that it's a bit more easy to control.
Okay.
And also on the point about ABSD, I actually know a friend who bought a second property. He paid the ABSD. He was one of the first buyers, and within a considerable period of like 6 months, the unit just adjacent to it, the exact same unit, had already appreciated more above the ABSD had paid. So
he made his money back.
Yeah, so there's no golden rule how to play the game. It really is specifically looking at the unit and the opportunities that are available in the market. Yeah.
I have a question here from Sapina. There were there's a lot of news on the redevelopment of District 18. So we're optimistic and recently bought a unit there. My question is, if the property in Dinest bought at launch in 2013 was sold today at a 13% profit, will that unit still be able to make a profit in the next 5 years? Sapina. Wow, very direct. Am I going to make money or not?
Ramesh, you want to take that one first? Very specific.
Dinest, I'm guessing it's about 5 years old, the property. So
well, it launched in 2013 apparently.
So they probably collected keys about 3 years later.
Yeah.
Okay.
Perhaps round about that.
So 5-6 years. Yeah.
So yeah, I think the lifeline for new properties, I think it's for the next 10 to 20 years is usually quite it's not so worrying. It's beyond that, then I'll be a bit more cautious in how to maybe exit and look at other properties. But I think for the next 10 years, you're quite good, and I don't think you have much to worry about. Having said that, of course, for any existing resale property, the appreciation is always a lot more moderate than a brand new launch, as we discussed earlier before as well, because you're entering at from just a plan, and then you get the key. So there's a huge jump when you collect the keys. But for resale properties, the appreciation is much lower. So I can't give you an exact figure, but I think for the next 5 years, you are relatively safe to hold on to the property.
Okay. Yeah. Well, I have a question here from Ricky Kwok, who says, what property investment advice for people in their early 50s? Harvey, anything to say about that?
Yeah, I'm close to that. So
that's not why I was asking you.
Just kidding. I think a good advice for someone who's close to 50 is once again is it depends on what you're holding, and it also depends on who you're making this move for. More often than not, we always look at real estate, as a brick and mortar. But the truth is, there are more emotive reasons to it. So for somebody like Ricky, let's say if you are doing it, you're asking, what should I do? Should I sell out my place now and take the money and enjoy my retirement? Then my answer to you is, let's see what you hold and let's see what we can get you into. If Ricky is I'm 50 right now, what should I do for my kids? Then perhaps I'll say, hey, maybe we can sell this and see what we can buy, maybe two, one for you, one for your kid. So with no context to the question, I would say that in Singapore, most people who are in their 50s right now would probably have done pretty well in their real estate investment, should they have been in that cycle. Because if you're around about 50 today, I would believe that you may have been on board some of those cycles that you have taken good capital growth and gains. So I think that there is a chance that Ricky, fingers crossed, had been so passionate listening to this webinar, I would believe I've done well. So I think you could probably take some off the table, enjoy his retirement a little bit, have a pina colada when, he can start flying again. So I think he can possibly look at, recycling that capital, enjoy some of that good work that he has done so far, and maybe invest in something that's a good passive income for himself. And of course, I'm here. You can always, check me up and then have a conversation. Sure.
Ramesh, you agree with that?
Yeah, I think it's ultimately what you want, what's your goals, what's the time frame, as I mentioned earlier. So and whether you're still willing to take risks, or you just want to have passive income, you want to relax. So it really depends on your personal goals. You need to do some soul searching and decide how we can help you, and we can work it out together. You can call me too.
I like the sell at the end of this. Yes. Well, thank you very much, guys. Unfortunately, that's all the time we have. And we really thank you so much, Harvey and Ramesh, for your time. But we would like to ask you to stay with us as we do a special lucky draw. That's what everyone's also waiting for. Now, we hope that you've all signed up for this lucky draw. The link is closed at the moment. So what we're going to do now is bring up the magic wheel. Bring it up and let's spin it. Here we go. Yes, it's going to be spinning right now. There you go. We got two more winners of $100 cash prize. So let's see who the first winner is. Because the money's going to come out of Harvey. Can you see? Give me the name again, Ong. Who's the winner one more time? Ong Hong Yi. Okay, Ong Hong Yi. Congratulations. Harvey will be giving you the $100.
Sure.
I'm just kidding. All right, let's spin it one more time for our second winner. And this one, of course, Ramesh will be buying you lunch.
Chickens cannot.
Ko Chunhua, congratulations. You won yourself $100 cash as well.
Congrats.
All right, good job. Well, first of all, thank you once again, Harvey and Ramesh, for
Thanks.
being with us and giving us a very good insight into investment and property as a valuable asset. And we also want to say congratulations to all our cash winners. And for those of you who have missed any of our webinars, don't worry, they're available via SPS2021.99.co. Okay, so once again, SPS2021.99.co. So you can go watch all these webinars, okay? And thank you once again for being a great audience these past 2 weekends with your fabulous questions as well. Well, I'm Vanessa Lopez bidding you farewell, great investing, and we'll see you for the next property show. Have a great and safe week ahead. Bye, guys. Thank you.
Cheers, man. Bye.
Thank you.